Hello viewers, welcome to the episode on capital structure. Two words which constitute to make the term capital structure are capital and structure. As we learnt in the former episodes, in the accounting, capital refers to the investment required for starting and running of a business, while structure is the manner in which anything is constructed. As such, capital structure is a mix-up of various sources of finance as we have discussed earlier in the desired proportion. For easy understanding, this episode is divided into 5 parts, namely meaning of capital structure, types of capital structure, components of capital structure, factors influencing capital structure, internal and external, optimum capital structure. Let us now understand the meaning of capital structure. In simple words, capital structure refers to the relative proportions of debt, equity and other securities that a firm has outstanding. Once the capital requirement of the firm is known, attention should be given to the type of capital resources that should be tapped to meet this need. A company can raise its capital from diverse sources, whether owned or borrowed. The owned sources comprise equity share capital, preference share capital and reserves and surplus. On the other hand, borrowed sources include debentures, secured and unsecured long-term loans, etc. The proportion of different type of sources used in the capital structure of a firm determines the long-term financial strength or soundness as well as profitability of the business. Capital structure can also be understood by the following formula, that is, capital structure is equal to equity share capital plus preference share capital plus reserves and surplus plus long-term borrowed funds. Types of capital structure. The capital structure of any concern may be simple, compound or complex. The type of capital structure adopted varies considerably for different types of companies depending upon the size, nature, regularity and adequacy of earnings. A newly formed company may adopt any of the capital structures discussed below. Number 1. Simple capital structure. A simple capital structure consists of single security base as a source of fund to finance the activities of the concern. For instance, equity share capital issued by a concern. It is safe to use such type of capital structure when the prospects of the earnings are unpredictable and uncertain. Number 2. Compound capital structure. In compound capital structure, a combination of two security bases in the form of equity and preference capital or equity share capital and debentures are used as sources of funds. It is advisable to use such a type of capital structure when the annual earnings of a concern are uncertain but average earnings are rather good. Number 3. Complex capital structure. A complex capital structure is made of multi-security base consisting of equity share capital, preference share capital, debentures and loans from financial institutions. This type of capital structure is advisable where there is certainty of stable and adequate income to pay off fixed financial charges. Components of capital structure. There are 5 basic components of capital structure, namely equity share capital, preference share capital, retained earnings, debentures and term loans and these components are further divided into two categories, namely owner's capital and borrowed capital, which are discussed below. Number 1. Owner's capital. The following items are included in the owner's capital. A. Equity shares. Equity shares are the fundamental and basic source for financing the activities of a business. They own the company and bear the ultimate risk associated with ownership. Among all the sources of finance, cost of equity capital is considered to be the highest, as its holders bear the maximum risk of the business. The residual remaining after paying claims of all other investors belongs to equity shareholders. B. Preference shares. Preferential shares carry a right of dividend at a fixed rate prior to any dividend paid to equity shareholders. Those shares which carry following preferential rights are termed as preference shares. Number 1. A preferential right as to the payment of dividend during the lifetime of a company, and number 2. A preferential right as to the return of capital at the time of liquidation of the company. C. Retained earnings. Retained earnings or plowing back of profits are considered to be the best source of internal financing. This type of financing is considered to be most convenient, as no efforts are required to raise such finance. This increases net worth without diluting the control of equity shareholders and does not create any fixed charge and obligation of repayment. Number 2. Borrowed capital. Borrowed capital comprises the following. A. Debentures. A debenture is an acknowledgement of debt or loan raised by a company. Company has to pay interest to debenture holders at an agreed rate under contractual obligation. Debentures may be secured or unsecured, convertible or non-convertible, registered or bearer. First, debentures or secured debentures. Interest paid on debentures is a charge against the profit and thus tax deductible, which makes this source of financing more popular during boom period. B. Term loans. Term loans are loans provided by banks and other financial institutions which carry a fixed rate of interest for a period of 3 or more years. Term loans may be mortgaged or simple. Several financing institutions like IFCI, SIDBI, SFCs, ICICI, LIC, GIC, etc. are engaged presently in the field of providing term loans to the companies. Internal and external factors influencing capital structure. Capital structure of a firm varies differently for different concerns. A concern's capital structure is determined by various internal and external factors. Internal factors. Let us study the internal factors. The various internal factors are: number 1. Nature of the business. The nature of business has an impact on its capital structure. Large manufacturing concerns have heavy investment in fixed assets and therefore require more fixed capital. Large fixed assets base serves as security for issuing debentures and other term loans. Hence, it may raise funds from external sources. On the other hand, service providing concerns may not require the heavy investments as compared to the manufacturing concerns. Number 2. Size of the firm. There is a direct relation between the capital structure and the size of a firm. The large firms are more diversified, have easy access to the capital market, receive higher credit ratings for debt issues, and pay lower interest rate on debt capital. Further, larger firms are less prone to bankruptcy and therefore larger firms tend to use more debt capital than smaller firms. Number 3. Growth of a concern. Different capital structures may be there at various stages of development of a concern. During early period of rapid development, equity capital and short-term loans are the main sources used to finance the activities of a concern. As it grows in size, other sources of financing, that is preference shares and debt capital, etc., can also be utilized. Companies during early stages of their development face tremendous problems in assembling funds from variety of sources due to their poor credit worthiness. Investors feel afraid because of great uncertainty involved in such companies, as no one easily becomes ready to take risk. Number 4. Growth in sales and earnings. Anticipated growth rate in sales provides a measure of extent to which earnings per share of a firm are likely to be magnified by leverage. The firm is likely to use debt financing with limited fixed charge only when the return on equity is likely to be magnified. However, the firms with significant growth in sales would have high market price per share, as a result of which they might prefer equity financing. The firm should make a relative cost benefit analysis against the debt and equity financing in anticipation to growth in sales to determine appropriate capital structure. Number 5. Business risk. There is a negative relation between the capital structure and business risk. The chance of business failure is greater if the firm has less stable earnings. Similarly, as a company finds it difficult to pay for the interest on debts, there is a probability of increase in the problems related to debt become more aggravating. Thus, as business risk increases, the debt level in capital structure of the enterprise should decrease. Number 6. Attitude of management. The attitude of persons who are responsible for the affairs of an organization should also be analyzed carefully while assigning weight to different factors affecting capital structure. Management's attitude regarding control of the concern and risk has to be noted minutely. Where management has strong will for exclusive control, preference shares and borrowings will have to be used for raising funds. Number 7. Cash flow stability. The firm's cash flow stability also affects its capital structure. If firm's cash flows are relatively stable, then it may not find no difficulties in meeting its fixed charge obligations. As a result, the firm may attempt to take the benefits of using leverage to some extent. Number 8. Period of finance. The period for which finance is required should also be considered while designing capital structure of a concern. If funds are required on a consistent basis, the concern should raise funds through issue of equity shares. If the funds are required for a relatively small period, that is a period between 6 to 10 years, it would be beneficial to raise funds through issue of debentures or redeemable preference shares. Number 9. Future plans. While designing capital structure, management should keep in mind the future expansion and development plans. Authorized capital should be kept more and equity capital should be issued in the beginning. Debentures and preference shares may be issued in future to finance the expansion plans. External factors. Now, let us discuss the various external factors influencing capital structure of a firm. Number 1. Nature of industry. Capital structure of a firm also depends on the nature of industry in which it operates. If there were no barriers in industry for the entry of new competing firms, the profit margin of existing firm in the industry would be adversely affected. As a result, the firm may find it more risky to use fixed charge bearing securities. Number 2. Market conditions. The magnitude of capital to be invested is also influenced by the prevailing market conditions. Readiness of investors to purchase a particular type of security in a given period of time, stage of business cycle, tax considerations, prevailing interest rates, risk and uncertainty regarding investment in the market, etc., combine to form market conditions. Number 3. Investors' attitude. The attitude of investors also play a key role in determination of capital structure. The bold investors who are ready to take risk and expect higher earnings prefer to invest in equity shares. On the other hand, cautious investors are interested in consistent and assured incomes. Therefore, they are more interested in investing in debentures and bonds. Number 4. Interest rate level. The prevailing interest rates play a very important role in determining the size of capital and its kind. It affects the choice of securities to be offered to investors. When high interest rates are there, all financing may be costly and vice versa. Number 5. Government regulations. Government rules and regulations play a vital role in capital structure decision. The SEBI has prescribed debt equity ratio norm of 2:1. A higher debt equity ratio of around 3:1 or higher has been permitted for large capital intensive projects. On the other hand, for small industrial projects, the debt equity norms have been liberalized through a number of reliefs, aids and concessions which have made possible very high levels of debt as compared to equity share capital. Optimum capital structure. The optimum capital structure indicates the best debt to equity ratio for a firm that maximizes its value. Putting it simple, the optimal capital structure for a company is the one which puts forward a balance between the idealistic debt to equity ranges, thus minimizing the firm's cost of capital. Theoretically, debt financing usually signifies the lowest cost of capital because of its tax deductibility. However, it is seldom the optimum capital structure, for as debt increases, it increases the company's risk. Optimum capital structure exists in a situation when a firm assumes to maximize the long run market value of the ownership shares. This varies from one firm to another. Even today, there is no single model for optimum capital structure which can be followed by any firm. Every firm in each industry has its own asset base and adopts its own finance policy. The financial structure of each firm is decided by the organizer, which depends upon the individual taste of risk taking in business. Many businesses get into risk because they grow faster than their capital will allow and because they have no plan to measure or provide for the resulting deficiencies. In such situations, optimum capital structure can help in minimizing the financial problems faced by the firms. Features of optimum capital structure. An optimum capital structure generally has the following features. Number 1, profitability. The capital structure of a company should be the most profitable. The most profitable capital structure is one when the cost of financing is at its minimum and earnings per share is at peak. Number 2, risk. The use of excessive debt threatens the solvency of the firm. To the point debt does not add significant risk, the debt should be used. Beyond this level, debt should be avoided. So, the content of the debt should not therefore increase the financial and business risk beyond the manageable limits. Number 3, simplicity. Simplicity means the capital structure of a company should not be having complicated number of securities in the beginning to raise funds. During initial stage, a company should raise funds through issue of equity shares only. Later on, as the company progresses, it may raise funds through issue of debt capital and preference shares. Number 4, flexibility. The capital structure of a company should be flexible enough to meet the requirements of changing conditions. The company should be able to adapt its capital structure with a minimum cost. It should also be in a position to provide funds wherever needed to finance its profitable activities. Number 5. Solvency. The issue of excessive debt may threaten the solvency of a company. It also increases financial risk of a company. The financial risk refers to the risk of a firm not being able to cover its fixed financial cost. High fixed cost increases the firm's financial leverage and hence its financial risk. This may also endanger the solvency of a firm in the long run. Therefore, debt should be used to the extent it does not add significant risk. Number 6. Liquidity. The debt capacity of a company is determined by its ability to generate future cash flows. It should have adequate liquidity to pay off fixed interest charges and principal sum when it becomes due. Number 7. Minimum cost of capital. The cost of capital means returns expected by providers of the capital. Cost of debt capital is interest payable on it, and cost of equity and preference share capital is dividend expected by the shareholders. An optimum capital structure is that where average cost of capital is the minimum. Number 8. Maximum control. The optimum capital structure is that which involves minimum risk of loss of control of the company. Equity shareholders are the real owners of the company and enjoy the voting rights. Preference shareholders and debenture holders have voting rights in special circumstances only. Therefore, the control over the company rests in the hands of equity shareholders. Number 9. Maximum return. Since equity shareholders are real owners of a company, an optimum capital structure should ensure maximum return on their investment. Number 10. Optimum utilization. Only that much capital should be raised which a company can utilize effectively. The situations of overcapitalization and undercapitalization should be avoided because both situations endanger the interest of the company in the long run. Number 11. Control. The firm should so devise its capital structure that it involves minimum risk of loss of control. When additional funds are raised, the controlling interests of the existing owners get diluted automatically unless they invest additional funds suitably. Even the preference shareholders would get the voting right if the dividend is not paid for 2 consecutive years. In such an event, the composition of the board of directors may change that may result in reduced level of control. To sum up, capital structure refers to the proportion of debt and equity in a firm. It is a reasonable combination of owned funds and borrowed funds. Capital structure is of 3 types: simple, compound and complex capital structure. The components of capital structure is divided into owner's capital, which includes equity shares, preference shares and retained earnings, and borrowed capital, which includes debentures and other term loans. There are various factors influencing the capital structure which are divided into internal and external factors. Internal factors include nature of business, size of the firm, growth of the concern, growth in sales and earnings, business risk, attitude of management, cash flow stability, period of finance, future plans. The external factors include nature of industry, market conditions, investors' attitude, interest rate levels, government regulations, etc. An optimum capital structure is most advantageous to the company. It can be obtained when all factors influencing capital structure are properly analyzed and balanced. Generally, capital structure should be planned keeping in view the interest of equity shareholders and the financial requirements of a concern. An optimum capital structure has certain features, namely profitability, risk, simplicity, flexibility, solvency, liquidity, minimum cost of capital, maximum control, maximum returns, optimum utilization and control.